Okay, let's unpack this. Retirement. For so many of us, it feels like uh, a moving target, right?
Yeah, definitely. Smaller pensions,
Yeah.
inflation worries.
Inflation seems to be constantly chipping away at savings, and the market, well, sometimes it feels less like investing and more like a white-knuckle ride you didn't sign up for.
That's a good way to put it. People want stability.
What you really want, or maybe even need, is reliable income coming in once you stop working. Without the constant stress of checking stock prices every 5 minutes.
That need for a dependable income stream, one that doesn't demand daily attention, that's absolutely a core concern, especially when you shift from building wealth to, well, living off it.
And that's exactly what the source we're diving into today addresses. It's an article called Retire with Confidence, 3 Dividend Legends.
Okay.
And this piece proposes a potential strategy focusing on dividend-paying companies. Specifically, 3 it holds up as dividend legends.
Dividend legends, interesting term.
Yeah. So our mission in this deep dive is really to extract the crucial points from this article, to understand why these 3 companies, Johnson & Johnson, PepsiCo, and Procter Gamble, why they're highlighted here as potentially reliable income generators for retirement.
Got it. So what does the article say makes a company a dividend legend? It can't just be paying a dividend.
No, exactly. It's about an uninterrupted track record, often like 25 years or more.
Okay, serious consistency.
And it requires a fortress-like balance sheet, something that can withstand economic shocks.
Makes sense. Durability.
Plus, these companies tend to operate in defensive industries, selling things people need pretty consistently.
Right, stuff people buy even when times are tough.
And critically, they show a consistent history of increasing their dividend year after year. That's key, the article stresses, for staying ahead of inflation over, decades.
That growth component is crucial for retirees.
Right, the article uses that great term, calling them fortresses. They're presented as sources of dependability, avoiding the kind of drama you often see elsewhere in the market.
Dependability, not drama. I like that.
So this deep dive is your shortcut. We're distilling this article, pulling out those essential nuggets, the surprising facts, so you get the core perspective on this retirement income strategy without having to read the whole thing yourself.
Okay, let's do it. So that fundamental need the article identifies, reliable passive income in retirement.
Yeah, let's hone in on that. When you stop working, your relationship with money just changes, doesn't it?
Completely. Active labor income goes away, and you need your assets, your savings, to reliably generate cash flow. You need it to cover your expenses.
Exactly. You need income you can truly count on. Income that isn't forcing you to sell assets at maybe the worst possible time just to pay the bills.
Mm-hmm.
And the article presents these dividend-paying companies, especially the ones with that long history of consistent growing payments, as a potentially powerful solution.
It makes the case that these companies have, weathered storms, recessions, inflation, global crises.
And still consistently return cash to shareholders. That's the core argument.
Okay, so that brings us to the first company the article highlights as a potential retirement rock star, Johnson & Johnson, ticker J&J.
Right. The article nicknames them the healthcare hero.
Mm-hmm.
And looking at their history, you can see why. They've been paying dividends since, 1944?
Since 1944. And what's particularly compelling, and the article really flags this, is that they've increased that dividend for over 60 consecutive years.
60 years.
That puts them in a very elite group known as dividend kings.
Over 60 years of raises. That's just a remarkable streak.
Yeah.
So what reasoning does the article give? Why J&J for retirement?
Well, the piece emphasizes the non-discretionary nature of healthcare. People need these products, these services, pretty much regardless of the economic climate.
True.
It also points to J&J's broad diversification, across pharmaceuticals, medical devices, and consumer health. That provides stability.
Although, didn't they spin off the consumer part?
Yes, the article mentions that. The recent spin-off of their consumer health division into Kenvue. The piece suggests this allows the remaining J&J to sharpen its focus on, higher margin pharma and medical device areas.
Okay, makes sense. And there's a detail the article really wants you to notice. It highlights J&J's AAA credit rating.
Yes, that AAA rating. That's a significant point for the article. It specifically notes this rating is considered better than the U.S. government's rating.
Wow, better than the government.
That's what the article states, and it uses this fact to underscore J&J's exceptional financial strength and stability. It implies a really high level of confidence in their ability to meet obligations, including those dividend payments, well into the future.
Okay, when you put it like that, comparing it to the government, it really does hammer home the perceived safety. So how does that translate into actual income potential, according to the article?
Well, the article notes J&J's typical yield is around 3%, but, and the article stresses this, the real power for retirees is the growth.
Right, that compounding effect.
Exactly. Over the last decade, the dividend's seen an average annual increase of roughly 6%.
Okay.
And the article gives an example. Say, a $300,000 investment today yielding 3%. That initially generates about $9,000 in annual income.
Right. $9,000 to start.
But project that consistent 6% growth out just 10 years, and that annual income stream is expected to grow to approximately $16,100.
So it almost doubles in a decade, just the income stream itself.
Pretty much. The article frames that perfectly. It's like giving your future self a steady raise year after year.
I like that framing.
Okay.
Moving on then. The article introduces the second company, PepsiCo, PP.
Yes. The one it calls the snack stock with sizzle.
Yeah, and the piece is quick to point out it's much more than just soda, isn't it?
Absolutely. The article makes a key distinction there. It suggests that while, beverage giants get attention, PepsiCo's strength for income investors, according to this source, lies significantly in its dominant snack division.
Like Doritos, Lay's.
Doritos, Lay's, Quaker Oats, major brands. The piece argues these snack segments tend to have stronger profit margins than just beverages alone.
Interesting point. And they have their own impressive dividend history, too.
They do. The article notes 52 consecutive years of dividend increases. So, also in that dividend king category.
Oh, another king. Okay.
It highlights PepsiCo's massive global footprint, and it describes its ability to adjust prices on popular products as a kind of built-in inflation hedge.
Meaning they can pass on rising costs.
That's the suggestion, that they can do it without significant consumer pushback because the brands are so strong.
That pricing power makes sense for those kinds of household names.
Yeah.
What do the numbers look like for PEP in the article?
The article puts PepsiCo's typical yield at around 3%, similar to J&J's starting point, and it notes the dividend has grown about 7% annually over the past decade, a little faster than J&J's example.
7% growth, okay.
It also points to a payout ratio that's the percentage of earnings paid out as dividends of approximately 65%.
And is that considered good?
The article considers it sustainable, meaning there's still room, cushion to continue growing the dividend safely without straining the company's finances.
Gotcha. And the example income?
The example provided is a $200,000 investment, yielding an initial $6,000 annually, but projected to grow to roughly $11,800 per year a decade later, thanks to that compounding 7% dividend growth.
So again, significant growth in the income stream over time. The article even adds a touch of humor, right? Mentioning Super Bowl snacks funding your retirement.
Yeah, it does a good job of making the connection tangible, that maybe your snack habits are contributing to your potential income stream.
All right, the third company highlighted is Procter Gamble, PG.
P&G. The article dubs them the recession-proof cash machine.
And their track record is just extraordinary, isn't it?
It's one of the longest streaks documented globally, according to the article. Procter & Gamble has increased its dividend for an astounding 68 consecutive years.
68 years, wow.
Yeah, the article really emphasizes this, nearly 7 decades of uninterrupted raises. It describes it as arguably the most reliable attendee you'd want at your financial retirement party.
Nice analogy. And their strategy, focusing squarely on daily necessities.
Precisely. Brands you probably use. Tide, Crest, Charmin, Gillette, Pampers.
Stuff you buy almost automatically.
Exactly. The article's reasoning is that people purchase these items pretty much regardless of what the economy is doing.
Yeah.
That makes PG's business model inherently more stable, or recession-proof, as the piece puts it.
Yeah, and that leads to pricing power again.
Yes. Strong brand loyalty for these essential goods gives them pricing power, which the article sees as a crucial advantage for income investors battling inflation. Operational excellence is also mentioned as a key strength for PG in the source.
Okay. Their starting yield is a bit lower than the others, though, isn't it?
It is. The article notes the yield is typically around 2.5%.
So why include them if the yield is lower?
Well, the article quickly counters that the sheer consistency, the reliability, and the steady growth potential, it highlights a mid-single-digit 10-year growth rate in the dividend more than compensate.
So consistency over initial yield.
That seems to be the argument. The example given for PG is a $250,000 investment, starting with about $6,250 in annual dividends, but projected by the article to grow to roughly $10,800 in 10 years.
Still substantial growth. And the article makes the point that while the focus is income, the share price for these kinds of stable companies also tends to climb steadily over the long term, right?
Yes, it does mention that, potentially preserving or even growing the principal investment alongside the growing dividends. That preservation of capital is definitely presented as a benefit, even though the main focus is the income stream.
Okay, so the article does touch on risk, though, because no investment is truly without risk.
Exactly, and the article acknowledges that up front. It's not claiming zero risk, but it frames the discussion around managing risk intelligently, particularly with retirement income in mind.
How does it say these companies manage risk?
The article argues that these specific dividend legends manage risk effectively because they possess wide moats.
Wide moats, like a castle.
Kind of. The article uses wide moats to describe sustainable competitive advantages that protect these companies from rivals.
So things like brand names.
Yeah, think brand loyalty so strong people won't easily switch. Massive global distribution networks they've built up, or maybe cost advantages because they're just so big. Scale matters.
Okay, that makes sense.
These factors, combined with strong balance sheets and what the article calls battle-tested track records, meaning they've performed through various economic cycles, are presented as reasons why these companies are considered lower risk, at least within the context of dividend investing for income.
So the approach the article advocates isn't about avoiding risk entirely, but maybe selecting investments that, in its view, are less susceptible to certain kinds of volatility compared to, say, speculative stocks.
Precisely. It's about collecting a predictable and hopefully growing cash flow stream. The article also points out that just investing in these three companies provides some diversification across different core sectors. You've got healthcare with J&J,
Snacks and beverages with PepsiCo,
and household essentials with P&G. The article presents that diversification as another layer of risk management.
Okay. Let's talk about bonds for a second. They're traditionally seen as, the safe haven for retirement income. How does the article weigh in on bonds versus this approach?
Yeah, the article directly compares this dividend stock approach to bonds. It does acknowledge bonds have a role, certainly, but it presents a critique.
What's the critique?
It notes that current bond yields might not be sufficient to meet income needs for some people. And crucially, bonds typically lack growth potential. They don't usually offer an inherent hedge against inflation.
Right, so the article's view is that a bond's fixed payment doesn't keep pace if costs rise over a, say, 20 or 30-year retirement.
That's the core argument, yes. The article positions dividend stocks, specifically these kinds of consistent dividend growers, as an inflation-fighting machine.
Inflation-fighting machine.
Okay. It emphasizes that the long-term focus should be on the growth of the dividend income stream, rather than getting too caught up in the day-to-day stock price fluctuation.
Right, focus on the income growth, not the price wiggles.
Right.
Okay, let's put it all together then with the sample portfolio allocation the article suggests.
Okay. The article provides a hypothetical example. It uses a $750,000 portfolio, specifically structured for generating retirement income, using just these three stocks.
Just the three.
Okay.
How does the article suggest allocating that $750,000?
It proposes putting $300,000 into J&J, $200,000 into PEEP, and $250,000 into PG.
Okay, specific amounts. And what does that allocation translate to in terms of starting annual income, according to the article?
Well, based on those typical yields mentioned, 3.0% for J&J, 3.0% for PP, and 2.5% for PG.
Right.
The article calculates an initial annual dividend income of $9,000 from the J&J portion.
Okay, $300K times 3%.
$6,000 from PP.
$200K times 3%.
And $6,250 from PG.
$250K times 2.5%. Got it. Bringing the total initial annual income from this specific $750,000 allocation to
$21,250 per year.
Okay, just over $21K to start.
Yes. And the article strongly emphasizes that this is just the starting point. It projects that with consistent dividend growth, that annual income stream is expected to increase significantly over the next decade.
Right, based on those historical growth rates.
Exactly. Plus, there's a potential for the underlying stock values themselves to appreciate over time as well.
And the article also points out the flexibility this income provides, right?
Yeah.
You can reinvest it or take the cash.
Yeah, it mentions that. You could reinvest the dividends maybe early in retirement to accelerate compounding, or you could take the cash directly to supplement other income sources like, Social Security or a pension.
So it's presented as a flexible, growing cash flow source.
That's the idea.
Okay, so to wrap up the core argument of this article, retire with confidence, 3 dividend legends. What's the bottom line?
Well, it makes a pretty compelling case based on its analysis that Johnson & Johnson, PepsiCo, and Procter Gamble are exceptionally reliable dividend-paying companies. It argues they're specifically well-suited for generating dependable, growing income in retirement.
And the reasoning boils down to,
Decades of consistent dividend increases, robust financial health. Remember that AAA rating for J&J defensive business models focused on essential goods, and those characteristics like strong brands and wide competitive moats.
okay, and this deep dive, hopefully, has given you that concise understanding of why these specific companies are highlighted in that article for a retirement income strategy. We pulled out those key facts and the rationale behind it.
Yeah, from the dividend streaks and credit ratings to the specific income examples the article provides, it's a way to grasp this particular perspective on building retirement income.
It distills the rationale behind why the article identifies these three, specifically, as potentially strong, stable pillars for a retirement income plan focused on dividends.
So here's a provocative thought for you to sit with as you consider this article's perspective. Given its strong emphasis on the stability and the consistent growth of the dividend income stream itself, how might shifting your focus, shifting away from the daily ups and downs of a stock's price and instead prioritizing its ability to reliably pay and increase its dividends, how might that fundamentally change how you think about building wealth, especially as you plan for or are maybe even living in retirement?